Hi, welcome to Chapter 10. We are now going to be doing Chapter 10. Last chapter we did Chapter 9, which was sales and cash receipts in a perpetual inventory system. Now we are doing purchases and cash payments in a perpetual inventory system. So the other side of the house. Sorry. So you're learning both sides of it. So a perpetual just means, remember, that you're not doing it periodically. You're not looking at the inventory only at one point in time, like the end of the year, and counting the physical inventory. You're keeping up with it on a routine basis daily and able to keep track of your inventory that way. Okay. So now we are going to, okay, sorry, just messing with my webcam, making sure I'm getting the right thing. Okay, so there's two learning objectives. This video is going to cover just the first learning objective, journalizing and recording transactions to the accounts payable subsidiary ledger and post to the general ledger along with a debit memorandum using a perpetual inventory system. 10.2, I'll journalize, record, and post cash payment transactions and prepare a schedule of accounts payable. So, learning objective, we've already said that. Okay, so free charges related to purchases. Free on board, FOB's destination stands for free on board. The seller pays the shipping cost. Legal title passes to the buyer when the goods reach their destination. Okay, so just important terminology to be aware of. And who gets charged these freight charges? Free on board shipping point, the buyer pays the shipping charges. Legal title passes to the buyer when goods are shipped. So purchase discounts are not taken on the freight. Okay, these are just, again, important terminology on how you book the delivery charges, on who is actually paying for the shipping. Okay, so recording and posting purchase transactions. You prepare a multi-part purchase requisition. One copy sent to purchasing, one to accounting, and one kept in the department making the request. The purchasing department prepares a purchase order. So here is a purchase order. So basically they're just saying, okay, we give you permission to purchase this. You're approving the price and what you're purchasing. Some companies make you do a purchase order for just about anything you're buying. Other ones are a little more looser and you don't have to do purchase orders for everything. But this is an example of a purchase order. Some accounting systems will do a purchase order for you. And then that purchase order becomes a sales invoice. Or some accounting systems just do invoices on their system. So here is an invoice then. So once the purchase order's approved, then you're getting an invoice from the company you ordered the inventory items from. So now you would have to record and post purchase transactions. So you would receive the goods and complete a receiving report. So you usually have a purchase order set up, and then at the time the items are received, you check the merchandise and make sure it's in good condition and marked it as received. A company does not record this purchase until the invoice is approved for recording and payment. So, at the time that it's actually received, that's when you do a journal entry. It's not at the time of the purchase order. So you verify the numbers before the invoice is approved for recording and payment. And then here are some transactions we have. So we're going to go through these transactions and record them in our ledgers. So April 2nd, purchase merchandise on account $5,000 and freight $50 from Abby Blake. Terms. You get a 2% discount if paid within 10 days, or otherwise the net amount is due in 60 days. So our rules are merchandise inventory at cost. We're going to debit $5,000 because that's how much the inventory costs. We also are going to have to pay the freight charges of $50 because of when the merchandise purchase, the inventory was transferred to us. So we're going to debit increase merchandise inventory is going to include our freight charges of $50. So we're debiting both of those accounts. And then we are increasing our liability, our accounts payable, $5,050. So when we're typing in the invoice, this is how we would type in that invoice. If I go back a couple of slides here, when we receive this invoice and when we've received the merchandise, then we can put the invoice into our accounting system and record a journal entry for this $5,050. So we're recording the lady's jacket as merchandise inventory, and the freight is also merchandise inventory. So we have a total of $5,050 of merchandise inventory, and we're preparing a check to be paid, so we're just putting in an accounts payable. It's going to be a liability that we owe Abby Blake Company. And once it's paid, then you'll clear out your accounts payable account. Okay, so that would be the journal entry we would record. If we decide to pay it within 10 days, we're going to get a 2% discount. So then we're going to make adjustments to this journal entry. Okay, so your accounts payable subsidiary ledger is different than your general ledger. It is like, it just gives you the detail of the accounts payable account. It lists vendors owed money from purchase account. So it's just a detailed listing of your accounts payable account is what the subsidiary ledger is. It needs to agree to your accounts payable account. The normal balance is always a credit. The accounts payable is the controlling account, and the sum of individual amounts owed should equal the balance in accounts payable. Okay. So here, a partial general ledger, you have your accounts payable account, and then you'd have your subsidiary ledger that would be all the vendors that you owe, like Abby Blake Company, Joe Francis Company, John Sullivan, Thorpe Company. And the sum of the credit balances you have in here should equal your accounts payable account. Kind of like it last chapter where you had the accounts receivable subsidiary ledger. Okay, so we got our subsidiary ledger and our accounts payable ledger over here. So we would do all these journal entries then. And these would just be our general journal entries. But you can see we have something Abby Blake. We have Thorpe and Company. We have John Sullivan. And then we actually pay Thorpe and Company. Abby Blake, we buy some more inventory, and then Sullivan Company. So you take those amounts and you actually record them in your subsidiary ledger. So right here, the Abby Blake, when we're putting into our accounts payable ledger, we also put it in our subsidiary ledger. Okay. A debit memorandum is a piece of paper issued by a customer to a seller. So for example, if we had defective hats, so then we're getting a discount basically, or we're returning items. So we're getting a little bit of discount on our invoice. So this was Arts Wholesale. So on Arts Wholesale, I wonder why, oh, actually it says to Thorpe and Company. And they have it all spelled wrong there, or unless it's really like that. Okay, so Thorpe, we're going to reduce our accounts payable balance and reduce our inventory for that credit for those defective hats. Okay, so that's how you record that. So the here is the adjustment for the $200 hats. So everything in your accounts payable should be booked somewhere over here. And you even have, your $200 return, and they should balance to each other. When you add up all these individual accounts, they should equal your accounts payable account. Okay. And then I just left some of the pages from the book out here on the back, just for your reference. Just to check. Okay, so this was Learning Objective 10.1. Make sure to watch 10.2 as well. Bye.